So there I was, sitting in front of the computer in another Finance Friday. I'm looking at my swing trading account and it's down by over $20,000. If that wasn't bad enough, Tesla in the last month is trading at $165,000 less than it was at its peak, at least for my 603 shares. I tell you, everything feels great when the stock market goes up, but when you come close to losing $200,000 in such a short period of time, boy, it can feel like a gut punch.
This is blasphemy. This is madness.
It's so bad, I hear that some people are actually praying to Jerome Powell asking for help.
Please, 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 save me.
And so today, on this day of reckoning, I made a tough decision. I sold over $200,000 in stocks. Anyway, if you're here, chances are you're trying to learn what's going on, why I sold $200,000 worth of stocks, and what we can learn from the situation by thinking critically. Hello, hello, hello. I'm Andrew and welcome to the Dad Manual. And this is my attempt as a dad, and only a dad, to talk about why I sold over $200,000 of stocks today. Full disclosure, I'm not a financial advisor and I'm not a fiduciary. I'm just here as a dad giving my perspective for your entertainment purposes. You should always do your own research and don't just blindly trust anyone on YouTube. Now, I understand it sounds a little weird that I, of all people, am telling you that I sold over $200,000 of stocks today. Especially since I've been on a kick that every single week you need to be investing. You need to be putting money into the market. And I'm still doing that, just to be clear. I am still investing every single week. What I did today was for specific reasons because of a specific situation that's going on. And I need to make certain I'm prepared for it. I can't risk everything. I want you to know, though, that even though I sold over $200,000 of stock today, including 200 shares of Tesla stock, that I still fully believe in the power of the stock market, and I still fully back Tesla. I have to admit something, though. That's right, I've been trading on margin, and I've been doing so for a while. Margin is essentially a form of debt. The type of margin I used came from M1 Finance. It allowed me to take up to 35% of my portfolio's balance as a loan at 2% interest. I did this so that way I could take further advantage of opportunities as I saw them in the market. Now, debt is a very powerful tool, but just like all Spider-Man fans will tell you, with great power comes great responsibility. This is because margin, when used improperly, can completely destroy your gains. It can force you to sell stocks when you least expect it and when you least want to. And when doing so, it can not only wipe out your gains, it can also force you into increased tax liability if you're not prepared. It's especially dangerous if you put it into the exact same account and even the exact same stocks that you originally margined against. When you do that, you might as well be shorting a stock as far as risk levels go. That's because you can maximize your losses while minimizing your gains. Remember, nobody's going to give you free money out of this. Brokerages, when they issue margin, expect you to be able to pay the money back. So you're not only paying interest, but you've got to have the capital to hold against that margin. That's why I use M1 Finance, is because at least the worst case scenario was if everything did tank all the way down, at least it would pay for the margin, they would force the call, and I'd only be out my original investment. Now in my case, I used margin as part of my growth strategy, and last year was able to turn $45,000, which purchased only Tesla stock, into about $695,000 up to about a month ago. Subtracting my $200,000 of margin, I was able to be left with $495,000 or an 1,100% return on my initial investment. And that's when things started going downhill. As of the close of market on March 4th, I actually was only $75,000 away from being margin called. This means that if Tesla stock had dropped all the way down to $500 a share, I could have been in a position where I would have lost most of my power on how to handle the situation. Now, when I looked at the finances, even if I had gotten out when I got out this morning, I was going to be protecting a 688% gain on my initial investment from a year ago. And I determined that protecting that 688% was much more important than risking everything by holding on with diamond hands. See, if you've watched my previous episodes, then you know I've been retired since 2017. As part of the deal with my wife, I made a promise to her that I would seek out a way for her to be able to retire in the year 2027. Now, things have gone phenomenally well this last couple of years, but I was not willing to risk everything over this course of the next couple of weeks because even though I don't like old wives' tales, there's a saying out there that the market can remain irrational longer than you can remain solvent. I did not feel like testing the waters. I do believe in the future that Tesla stock is not only going to the moon, but it's on its way to Mars. That doesn't mean short-term volatility by being pushed from the fear index needs to push me completely out of my future just because I'm trying to be greedy right now. So as any good gamer would do, I decided it was time to manage my risk. I decided that it was time to get rid of all of my lowest conviction stocks and even sell 200 shares of my highest conviction stock, Tesla. And oh man, did that make my stomach turn when I sold 200 shares of Tesla. I did not want to do that. It was more important though for me to gather $240,000 to sit on the side so that way I'd be protected in the event the market continues to go down. Now, I did this with $150,000 of sales in M1 Finance, $72,000 of sales in Fidelity, and the remainder coming from my Robinhood, my Webull, and my Cash App accounts. Now that I've paid off my margin, I have an additional $40,000 sitting on the sideline that if the market continues to dip, I can take advantage. This is important because just like Kathy Wood talks about, sometimes when you have market dips, you need to consolidate your lowest conviction stocks and you need to go into just your highest conviction stocks. I essentially did that during this process. And for those of you wondering, yes, I can take out another $84,000 out in margin on my M1 Finance account. I have no plans to do that though, because right now we're in extreme market volatility. And I want to see what's going to go on for the next few weeks before I make any decisions. Because remember, debt is a tool. It needs treated with respect. You don't just willy-nilly take out every dollar you can in debt and go make it rain out in the stock market. That's not how you make money. Now moving on to our stock picks again this week. Again, in our value stock account, I went ahead and I picked Dropbox. I think this is still a good value play. You can see overall, even though we keep putting 25 bucks into it every week, we're still beating the market, right? We're above $125. That's actually good when we're looking at our 4 accounts because some of our accounts aren't doing so hot, if you know what I mean. There's been a lot of rebalancing going on, and that'll probably be a future video as to why this actually happens. But needless to say, there's a lot of rebalancing going out of growth and back into value as people think that the economy is going to open back up and as bond rates rise. I don't necessarily think it's warranted. That's my own personal opinion. Some people have thought it's been frothy for way too long. I'm still sticking by the idea that if you buy at the peak, 20 years down the road, you're going to be happy that you bought then. Just do consistently, slow and sure wins the race every time. But Dropbox has been doing really well for us. Moving on to our next stock, you can see our dividend account. Purchasing Verizon seems to be a winner chicken dinner for us. Seems to be holding up really well in this growth transition, which kind of surprises me, being Verizon's a 5G stock. That actually really surprises me that it's holding up so well. However, the fact that it's holding up doesn't mean I should look a gift horse in the mouth. Put in another 25 bucks this week, and I continue to expect that we're going to be continuing to put in $25 every single week throughout the year. I'm excited to be able to show you how dividends work in this account when they first get issued. So on to our growth stock. Holy smokes, Tesla, you know what? It seems to be down. It never seems to want to crop back up. That's totally okay because it allows us to drop our cost basis down. You can see after having purchased this week, we're already down into the 750 range. So next week, if it drops down again, I don't care. I'm buying another $25. As a growth stock, it doesn't get much better than this. This is probably the most popular stock out there on the stock market right now, and we're going to continue to pump it on in because I see no reason that this is not a multi-trillion-dollar company in 2025 or 2030. So that's just keep on chugging strong, man. Just keep on chugging strong. You're just getting better averages to buy into. And now last but not least, our S&P 500 index account, VOO, put in another $25 there. You can see that we're still down 1%. That's how rough the market has been to us as a whole right now. The whole S&P 500 is still down 1%, even though we're having this massive transition into the supposed recovery stocks. Well, whatever, guys. I think you should just keep putting it on in here into VOO if you're looking for an index fund, because you don't get much better than tracking the U.S. economy. As long as you believe in the U.S. economy, this is a fine place to put your money. Well, that about wraps up today's episode. What I want to know, though, is how you feel about the current market conditions. Are you selling everything, or are you holding on for your dear life with diamond hands? Tell me about it down in the comments below. And while you're down there, hit that thumbs up button if you haven't done so already. Hit that subscribe button if you're not subscribed to the channel, and share this with one of your friends if you found value. It really helps out the channel. And thanks for joining me today. Here at the Dad Manual, we make long-form content every Tuesday and Friday. And this week, we started releasing our shorts series every Monday, Wednesday, and Thursday. And until next time, I'm Andrew Sherman. This is the Dad Manual. And always remember, failure isn't bad. Failure to try and learn is. Have a good one.